There is a dangerous myth on Wall Street that has destroyed more wealth than any market crash. It is the myth of the safe blue chip stock. The idea that if you just buy big established companies with long track records and hold them forever, you cannot lose. That these giants are too big to fail, too dominant to decline, too essential to disappear. I am here to tell you that this myth is a lie. And right now, 4 of the most widely held blue chip stocks in America are about to prove just how dangerous this lie can be. I have been investing for over 60 years. I have seen blue chips that seemed invincible get destroyed. I watched Kodak go from a dominant global brand to bankruptcy. I watched General Electric go from the most valuable company in America to a broken shell of its former self. I watched Sears go from the Amazon of its day to liquidation. I watched IBM go from the undisputed king of technology to an afterthought. These were not small companies. These were not speculative bets. These were the bluest of blue chips. Companies that widows and orphans were told to buy and hold forever. Companies that sat in pension funds and endowments and retirement accounts across America, and they were destroyed not overnight. Slowly, painfully, while investors held on and hoped things would get better. Things did not get better. They never do once the fundamental rot sets in. Let me tell you about a conversation I had with a friend of mine back in 2000. He was a successful businessman, very intelligent, very financially sophisticated. He had most of his net worth in General Electric stock when I asked him why. He looked at me like I was crazy, Carl. He said, "It is General Electric Jack Welch, the most admired company in America. The stock has gone up every year for 20 years. It is the safest investment in the world." I told him that nothing is safe forever, that competitive advantages erode, that management changes, that the world changes. He laughed and said I was being paranoid. He kept holding. Over the next 20 years, General Electric lost over 90% of its value. My friend lost most of his net worth. He went from being wealthy to being comfortable, which is a nice way of saying he went backwards by millions of dollars. And it happened so slowly that he never realized what was happening until it was too late. That is the danger of blue chip complacency. You think you are safe, you think you can just hold forever and everything will be fine. And by the time you realize you were wrong, the damage is done today. I am going to warn you about 4 blue chip stocks that I believe are heading for the same fate. 4 companies that millions of Americans own in their retirement accounts right now. 4 stocks that Wall Street analysts still rate as buys. 4 investments that could devastate your portfolio if you do not act. I am not telling you this to scare you. I am telling you this because I have seen this pattern before. I recognize the warning signs, and I believe you deserve to know what I see, even if it is uncomfortable to hear. Let me start by explaining what makes a blue chip vulnerable to destruction, because understanding the pattern is more important than any individual stock recommendation. If you understand the pattern, you can identify danger in your own portfolio without waiting for someone like me to warn you. The first warning sign is when a company's competitive advantage starts to erode. Every great business has something that protects it from competition. A brand, a patent, a network effect, a cost advantage, something that allows it to earn above average returns year after year. When that advantage starts to weaken, the company becomes vulnerable. The dangerous thing is that competitive advantages often erode slowly. The quarterly earnings still look fine, the dividend still gets paid, the stock price holds up. But underneath the surface, the moat is filling in. Competitors are catching up, technology is changing. Customer preferences are shifting. By the time the erosion becomes visible in the financial statements, it is often too late to act. The second warning sign is when management becomes complacent or defensive. Great companies are built by hungry, innovative leaders who constantly push for improvement. But success breeds complacency. Over time, the founders retire or die. Professional managers take over. The culture shifts from offense to defense. The focus moves from growing the pie to protecting the existing slice. You can see this in how management talks about competition. Confident leaders acknowledge competitors and explain how they plan to win. Defensive leaders dismiss competitors or pretend they do not exist. When a CEO starts saying that the competition does not matter, that is when you should worry most. The third warning sign is when the company starts prioritizing financial engineering over operational excellence, buybacks funded by debt, dividends maintained even as earnings decline, acquisitions made to disguise organic stagnation, accounting tricks that boost short-term numbers at the expense of long-term health. When management focuses more on the stock price than the business, disaster eventually follows. The fourth warning sign is when the company operates in an industry facing structural decline. Some industries are simply in permanent decline. No amount of good management can overcome an industry that is shrinking. The best you can do is manage the decline gracefully. But most management teams are not honest about this. They talk about turnarounds and transformations that never materialize. Now let me tell you about the 4 blue chip stocks that are displaying all of these warning signs. The first stock is Walgreens Boots Alliance. This was once one of the most reliable investments in America, a drugstore on every corner, millions of prescriptions filled every year. A dividend that had been increased for decades. The kind of steady, boring business that financial advisors love to recommend to their conservative clients. But Walgreens is dying, is dying right now, and the stock price, as beaten down as it already is, does not fully reflect how bad things are going to get. Let me explain what is happening to this company, because the details matter. The retail pharmacy business model is broken, fundamentally, irreparably broken. Pharmacies make money by filling prescriptions and collecting reimbursements from insurance companies and pharmacy benefit managers. But the PBMs, which are controlled by competitors like CVS Health and United Health, have been squeezing reimbursement rates for years. They pay pharmacies less and less for each prescription filled. Every year, the reimbursement gets worse. Every year, the margin on each prescription shrinks. Think about the perversity of this situation. Walgreens depends on PBMs to get paid, but the PBMs are owned by their competitors. CVS owns Caremark. One of the largest PBMs, United Health, owns Optimarex, another giant PBM. These companies have every incentive to squeeze Walgreens and every ability to do so. They set the reimbursement rates. They decide which pharmacies get included in their networks. They can favor their own retail pharmacies over Walgreens whenever they want. At the same time, costs have been rising. Labor costs have increased substantially as minimum wages have gone up and as the tight labor market has forced retailers to pay more. Rent costs have increased, especially in urban locations. Regulatory compliance costs have increased as states have imposed new requirements on pharmacies. Theft has become a major problem, with organized retail crime costing the company hundreds of millions of dollars per year. The spread between what pharmacies get paid and what it costs them to operate has been shrinking relentlessly. Many independent pharmacies have already gone out of business. Thousands of them across America have closed over the past decade. The chains like Walgreens have survived longer because of their scale. But even scale cannot overcome fundamentally broken economics forever. Walgreens has been closing stores, hundreds of them, thousands over the next few years, according to their announcements. They are trying to shrink their way to profitability. But here's the problem with that strategy. When you close stores, you lose customers. Some of those customers go to CVS, some switch to mail-order pharmacy, some use Amazon Pharmacy. You do not get to keep all the revenue while eliminating the costs. The revenue shrinks too. Often it shrinks faster than the costs. The company loaded up on debt to make acquisitions that have not worked out. They bought a stake in a primary care company that has been a disaster. They have tried to pivot into healthcare services, but they are competing against companies with far more resources and expertise. Every strategic move they have made in the past 5 years has failed. The dividend, which was once sacred, has already been slashed. They cut it by nearly 50%, and I believe more cuts are coming. The company cannot afford to pay out cash it does not have. When the next round of cuts comes, the income investors who have been holding on will finally capitulate. The stock will crater. Management has been reshuffled multiple times. New CEOs come in with turnaround plans that never work. The strategy changes every couple of years. That kind of instability is a red flag. Good companies do not need constant management changes. They have consistent leadership executing a consistent strategy. I believe Walgreens could ultimately go bankrupt or be broken up and sold for parts. The retail pharmacy industry is consolidating, and Walgreens is not going to be a survivor in its current form. The company that seemed like such a safe investment 20 years ago is now a value trap that will destroy whatever capital remains invested in it. The second blue chip heading for destruction is Intel Corporation. This one might surprise you because Intel is a legendary American technology company. They invented the microprocessor. They powered the personal computer revolution. For decades, having Intel inside was a mark of quality and performance. The Intel chime in advertisements was one of the most recognized sounds in the world. But Intel has fallen catastrophically behind in chip manufacturing, and I do not believe they can catch up. The competitive advantage that made Intel great has been completely and utterly eroded. What was once the most valuable competitive position in technology has become a liability. Let me explain what happened, because this is a cautionary tale about what happens when a dominant company gets complacent. Intel used to be the undisputed leader in semiconductor manufacturing. They had the most advanced fabrication technology in the world. They could make smaller, faster, more efficient chips than anyone else. This was not a slight lead. This was a multiple generation lead. When Intel released a new chip, competitors were still trying to figure out how to make the previous generation. That manufacturing lead was their moat. It allowed them to charge premium prices because their chips were simply better than anything else available. It allowed them to earn fat margins because the technology advantage translated into performance advantage, which translated into pricing power for decades. If you wanted the best processor for a personal computer or a server, you bought Intel. There was no real alternative, but Intel got complacent. Success made them lazy. They underinvested in next-generation manufacturing technology because the current technology was still generating profits. They made strategic mistakes, betting on the wrong process nodes at the wrong times. They delayed critical transitions because they were focused on maximizing profits from existing products rather than investing in future products. Meanwhile, a company called TSMC in Taiwan kept investing aggressively. They kept pushing the boundaries of what was possible in semiconductor manufacturing. They attracted the best engineers in the world. They spent billions of dollars on research and development. They made aggressive bets on new technologies while Intel was playing it safe. And somewhere around 2018 or 2019, TSMC passed Intel. They became the manufacturing leader for the first time in Intel's history. Someone else could make better chips than Intel could make. Today, TSMC is 2 or 3 generations ahead of Intel in manufacturing technology. The gap is enormous. Apple uses TSMC for its M-series chips, which now power Mac computers that used to run on Intel processors. Apple literally replaced Intel chips with its own chips made by TSMC because they were better. NVIDIA uses TSMC for its AI chips that are the foundation of the artificial intelligence revolution. AMD uses TSMC for processors that now compete with and often beat Intel in performance benchmarks. Qualcomm uses TSMC. Every company making cutting-edge chips uses TSMC. Intel is trying to catch up. They have announced massive capital spending plans. They are building new fabs. They are promising to regain manufacturing leadership by 2027 or 2028. But I am deeply skeptical. Catching up in semiconductor manufacturing is not like catching up in other industries. This is the most technologically complex manufacturing in the world. The machines cost hundreds of millions of dollars each. The processes involve manipulating matter at the atomic level. The expertise takes decades to develop. You cannot just throw money at the problem and expect to close a multi-year gap in a few years. Meanwhile, Intel is bleeding money. Their core PC and server chip businesses are declining as customers switch to AMD and ARM-based alternatives. The gross margins that made Intel so profitable have collapsed. They are burning through cash trying to fund the turnaround while the existing business deteriorates. The government is providing subsidies through the CHIPS Act, which has helped Intel's stock price. But subsidies do not change the fundamental competitive dynamics. They might slow the decline, but they cannot reverse it. Intel is competing against TSMC, which has better technology, better manufacturing expertise, and the backing of the Taiwanese government. It is also competing against Samsung, which has nearly unlimited resources from the Korean conglomerate structure. I believe Intel's turnaround will fail. The stock has already fallen substantially from its highs, but it has further to fall. The market is still pricing in some probability of success. When it becomes clear that the turnaround is not working, that probability goes to zero and the stock collapses. The third blue chip heading for destruction is 3M Company. This is another legendary American industrial company. They invented Post-it notes and Scotch tape. They have over 60,000 products sold in virtually every country in the world. They have paid dividends for over a century, the ultimate boring, safe blue chip investment. But 3M is drowning in legal liability that could consume the entire company. The lawsuits are coming from multiple directions. The biggest exposure is from PFAS chemicals, sometimes called forever chemicals because they do not break down in the environment. 3M manufactured these chemicals for decades. They are now found in drinking water supplies across America. They are linked to cancer and other serious health problems, and 3M is being held responsible. The company has already agreed to pay over $10 billion to settle claims from public water systems. But that is just the beginning. There are thousands of individual lawsuits from people who claim they were harmed by PFAS exposure. There are lawsuits from states. There are lawsuits from other countries. The total liability could be $30, $40, $50 billion or more. Nobody knows the final number because new lawsuits keep getting filed. Then there are the earplug lawsuits. 3M supplied earplugs to the military that allegedly were defective and caused hearing damage in veterans. There were over 200,000 individual claims at one point. The company has been fighting these in court, but they have lost several trials with significant verdicts. The total exposure here could be another $10 to $20 billion. Add it all up, and 3M faces potential liabilities that exceed its market capitalization. Think about that. The legal claims against this company could be worth more than the entire company is worth on the stock market. That is an existential threat. Management has tried to address this through corporate restructuring. They spun off the healthcare business. They are trying to isolate the liabilities in certain legal entities. But plaintiffs' lawyers are sophisticated. They will fight these maneuvers. The courts may not allow 3M to escape liability through financial engineering. Meanwhile, the underlying business is nothing special. 3M has dozens of different product lines, but none of them are growing particularly fast. The company has been a mediocre performer operationally for years. Without the legal overhang, it might be a decent slow growth value stock. With the legal overhang, it is uninvestable. I believe 3M could ultimately file for bankruptcy to address the legal liabilities, similar to what Johnson & Johnson has attempted with its talc litigation. That would likely wipe out common shareholders or leave them with pennies on the dollar. Even if bankruptcy is avoided, the cash drain from legal settlements will consume capital that could otherwise go to dividends and buybacks. Shareholders lose either way. The fourth and final blue chip heading for destruction is Nike. Now, I know this one will be controversial because Nike is an iconic brand. The swoosh is recognized everywhere in the world. Michael Jordan, Tiger Woods, LeBron James, Serena Williams, Cristiano Ronaldo, the greatest athletes of multiple generations, have worn Nike products. The brand has been built through decades of brilliant marketing and authentic connections with sports and culture. But Nike is losing the sneaker wars, and the stock price does not reflect how much trouble this company is in. Let me explain what is happening, because this is a story about a company that made a series of strategic mistakes that are now compounding against them. Nike's competitive advantage has always been its brand and its relationships with elite athletes. People paid premium prices for Nike products because they wanted to be associated with greatness. They wanted to wear what their heroes wore. They wanted to feel like athletes, even if they were just going to the grocery store, that emotional connection. justified prices that were far above what generic athletic wear would cost. For decades, this formula worked brilliantly. Nike would sign the best athletes. They would create signature shoes and apparel lines around those athletes. They would market those products through compelling advertising, and consumers would pay premium prices to feel connected to sporting excellence. But the athletic footwear market has changed dramatically in recent years, and Nike has failed to adapt. New competitors have emerged with innovative products, and compelling marketing brands like On Running have captured significant market share in the running category by focusing obsessively on technology and performance. Their shoes genuinely feel different. They have features like the CloudTech cushioning system that runners love. Hoka has done the same thing with their maximalist cushioned shoes that have become incredibly popular with everyone from elite marathoners to casual joggers. These brands started small, but they have grown explosively. They have taken share directly from Nike in the running category. They have attracted younger consumers who want something different, something fresh, something their parents do not wear. The lifestyle sneaker market has also shifted against Nike. Nike used to dominate with franchises like Air Force One, Air Jordan, and Dunks. These shoes were cultural phenomena. People waited in line for hours to buy limited releases. Resale prices soared to multiples of retail. The scarcity and exclusivity created intense demand, but Nike oversaturated the market. They got greedy. They put these products in every retailer at every price point. They increased production to maximize revenue. The exclusivity that made these shoes desirable evaporated when you can buy Air Force Ones at every Foot Locker and every department store and every online retailer. They stop being special. They become ordinary, and ordinary does not command premium prices. Now those franchises are in decline, and Nike does not have clear replacements ready. They have been so focused on milking their existing franchises that they have underinvested in developing new ones. The pipeline is weak. The innovation engine has stalled. Meanwhile, Nike made a strategic mistake that is proving catastrophic. They pulled back from wholesale retail partners to focus on direct-to-consumer sales. The theory was that selling directly through Nike stores and Nike.com would improve margins and customer relationships. They would capture the full retail margin instead of sharing it with retailers. They would own the customer data and the customer relationship. The theory made sense on paper, but the execution was terrible. They alienated retail partners like Foot Locker, who had built their businesses around Nike products. They lost shelf space that competitors happily filled, and their own direct channels have not grown fast enough to compensate. The China business, which was supposed to be a major growth engine, has stalled. Chinese consumers are increasingly choosing domestic brands over Western brands. Nationalism plays a role. So does the fact that Chinese brands have genuinely improved their products. Nike is losing share in the world's second largest market. The numbers are ugly. Revenue has been declining. Inventory has been bloated, forcing discounting that destroys margins. The company has announced layoffs and cost cuts. They replaced the CEO, bringing back a veteran executive to try to turn things around. But turnarounds in consumer brands are incredibly difficult. Once you lose cultural relevance, once consumers decide your brand is for their parents rather than for them, it is very hard to recover. I believe Nike is heading for a prolonged period of stagnation and decline. The stock has already fallen significantly, but it is still priced as a growth company. The multiple assumes that the turnaround will work and growth will resume. If the turnaround fails, which I believe it will, the stock has another 30 to 50% downside. Now let me step back and talk about what these four companies have in common, because the pattern is more important than any individual stock. All four of these companies were once dominant leaders in their industries. Walgreens was the leading drugstore chain. Intel was the undisputed leader in semiconductors. 3M was the premier industrial conglomerate. Nike was the king of athletic footwear and apparel. They had brand scale, distribution, and competitive advantages that seemed insurmountable. But competitive advantages are never permanent. They erode over time as technology changes, as competitors adapt, as customer preferences shift. The companies that thrive over decades are the ones that constantly reinvent themselves, that stay paranoid about competition, that invest in the future even when the present is comfortable. These 4 companies got comfortable. They stopped innovating as aggressively. They focused on financial engineering instead of operational excellence. They dismissed competitors until it was too late, and now they are paying the price. All 4 of these companies are also dealing with problems that are largely self-inflicted. Walgreens made bad acquisitions and failed to adapt to changing industry dynamics. Intel underinvested in manufacturing technology and lost its lead. 3M manufactured chemicals it knew were dangerous and is now facing the consequences. Nike oversaturated its brands and alienated its retail partners. These are not companies that were destroyed by unforeseeable external forces. These are companies that destroyed themselves through bad decisions. This is important because it means the problems are not going to magically solve themselves. Bad management decisions compound over time. The hole gets deeper, the competitive gap gets wider. By the time the problems become obvious to everyone, it is usually too late to fix them. All 4 of these companies still have significant institutional ownership. They still sit in index funds that have to own them. They still get bought by financial advisors who recommend blue chips to conservative clients. There is still a bid for these stocks from people who have not done the work to understand how broken these businesses are. That institutional support is why these stocks have not fallen further already. But institutional investors eventually capitulate. When the earnings keep disappointing, when the dividends get cut, when the turnaround plans keep failing, even the most patient institutions sell. And when they sell, the stocks crater. Let me talk about what you should do if you own any of these stocks. The simple answer is to sell. Do not wait for a turnaround that is not coming. Do not hope that management will figure it out. Do not tell yourself that the stock is already down so much that it cannot fall further. It can always fall further. Stocks can go to zero. Blue chips can go bankrupt. It has happened before, and it will happen again. I know selling is emotionally difficult. You might have owned these stocks for years. You might have unrealized losses that you do not want to recognize. You might have an emotional attachment to the companies or the brands. But investing is not about emotions. It is about allocating capital to where it will generate the best returns. And these 4 stocks are not going to generate good returns. The money you have invested in these companies could be redeployed into businesses that are growing, that have expanding competitive advantages, that have management teams executing effectively. Why would you leave your capital in declining businesses when there are better alternatives available? Some people will argue that these stocks are cheap, that they trade at low multiples to earnings or book value. But cheap is not the same as undervalued. A stock can be cheap for good reasons. If the earnings are going to decline, if the book value is going to be impaired, if the dividends are going to be cut, then a low multiple is not a bargain. It is a trap. Value traps are some of the most dangerous investments you can make. They look cheap on traditional metrics. They have famous names and long histories. They pay dividends that seem attractive. But they destroy capital slowly and relentlessly as the underlying businesses deteriorate. You collect your 3 or 4% dividend while the stock falls 20 or 30%. That is not a good trade. I have seen value traps destroy investors over and over again throughout my career. Smart people who should know better get seduced by low valuations and high yields. They convince themselves that the bad news is already priced in, that things cannot get worse. But things can always get worse. And with structurally challenged businesses, things usually do get worse. Let me also address the argument that these companies are too big to fail, that they will be bailed out or rescued somehow. This is wishful thinking. Kodak was too big to fail. General Electric was too big to fail. Sears was too big to fail. They all failed anyway. The government does not bail out companies just because they were once great. The market does not reward companies just because they have long histories. The only thing that matters is whether a business can generate cash flows and returns going forward. The past is irrelevant. The brand name is irrelevant if customers stop buying the products. The history is irrelevant if the competitive position has eroded. What matters is the future. And for these 4 companies, the future is bleak. I want to close with a broader point about portfolio management and risk. Many investors think they are diversified because they own 20 or 30 different stocks. But if those stocks are all blue chips in structurally challenged industries, you are not diversified. You are concentrated in a particular type of risk, the risk that yesterday's winners become tomorrow's losers. True diversification means owning different types of businesses with different risk profiles. It means owning some companies that are growing and some that are mature. It means owning some domestic and some international. It means being willing to sell the companies that are not working, even if they have famous names and long histories. The best investors I have known are ruthless about cutting losses. They do not fall in love with stocks. They do not hold on to losers hoping for a turnaround. They constantly evaluate every position and ask whether it still makes sense. If it does not make sense, they sell. No hesitation, no emotion, just clear-eyed assessment and decisive action. That is what I am urging you to do with these 4 stocks. Walgreens Boots Alliance, Intel Corporation, 3M Company, Nike. Evaluate them honestly. Look at the competitive dynamics, look at the management execution, look at the structural challenges, and then make a decision based on the facts, not on hope or nostalgia. The myth of the safe blue chip has destroyed too much wealth already. Do not let it destroy yours. I want to leave you with one final thought. The best time to sell a dying blue chip is before everyone else realizes it is dying. Once the decline becomes obvious, once the problems are on the front page of the Wall Street Journal, once the analysts finally downgrade to sell, it is too late. The stock has already collapsed. The wealth has already been destroyed. Right now, these 4 stocks still have believers. They still have analysts with buy ratings. They still have institutions that hold them because they are in the index. They still have retail investors who cannot accept that their safe investments are not safe at all. That is your window. That is your opportunity to get out before the crowd stampedes for the exits. Use it. I have been doing this for over 60 years. I have seen more blue chips rise and fall than most people can imagine, and I can tell you with absolute certainty that there is nothing special about a company's past that protects it from its future. The only thing that matters is whether the business can compete and generate returns going forward. Walgreens cannot, Intel cannot, 3M cannot, Nike cannot. Not in their current forms, not with their current strategies, not against their current competition. Get out now, redeploy your capital into companies that are winning, not dying. Your future self will thank you for having the courage to act when everyone else was paralyzed by hope and nostalgia. The myth of the safe blue chip is just that, a myth. Do not let it destroy your wealth the way it has destroyed so many others.